Your money-making broadcast starts now. Markets closed mixed today, with the Dow eking out a modest gain while the Nasdaq slipped and small caps struggled. But behind this seemingly calm facade, a powerful storm is gathering across multiple fronts. Three forces converge this week: a new Federal Reserve chairman taking office on Friday, an escalating crisis in the Middle East threatening global oil supplies, and the most anticipated earnings report of the year from Nvidia. Each alone would be enough to move the markets very meaningfully. Together, they create a rare convergence of uncertainty that investors simply cannot afford to ignore. The S&P 500 closed essentially flat at $738.61. The Dow rose 0.33% to $497. The Nasdaq Composite dropped nearly 0.5% on weakness in rate-sensitive technology names. Small caps lagged notably, with the Russell 2000 falling 0.6%. Only the Dow managed a positive finish, a clear sign of the quiet rotation underway from growth stocks toward value and defensive sectors. The VIX slipped to 17.82, suggesting options markets remain calm for now, but that composure may not survive the gauntlet of events lined up this week. Let us break down each of these three stories and what they mean for your portfolio. The Warsh era begins. The single most important story of today's session was not a stock price or an economic data point. It was a name. Kevin Warsh has been confirmed as the next chairman of the Federal Reserve, assuming office this Friday. This is a tectonic shift for monetary policy in the United States. Warsh is widely viewed as the most hawkish Fed chair candidate since Paul Volcker in the early 1980s. And he inherits an economy that is running dangerously hot. April CPI came in at 3.8%, the highest reading since May 2023. Producer prices surged 6%. Consumer sentiment hit an all-time low this month. Consumer staple companies are already warning about spending pullbacks as households feel the squeeze from higher prices and elevated gasoline costs. The bond market reacted immediately to the confirmation. The 10-year Treasury yield touched its highest level in over a year. Rate-sensitive sectors sold off hard across the board. Solar stocks were crushed, with Enphase Energy tumbling more than 6%. Small caps underperformed the broader market significantly. The auto sector also felt the heat, with Ford and General Motors both declining on the day. But financial stocks held their ground. Regional banks edged higher on the prospect of wider net interest margins if rates go up. The Dow Jones, heavy with financials and industrials, managed a positive close. This is the early footprint of what analysts are calling the Warsh effect, a repricing of assets based on the expectation that rate cuts are off the table and rate hikes are back on the agenda. For investors who built portfolios around the low-rate thesis, this is a wake-up call. Iran and the oil wildcard. While Wall Street was still processing the Warsh confirmation, the Middle East crisis took another dramatic turn. President Trump announced he has postponed a planned military strike against Iran, but his carefully chosen words carried an unmistakable warning: the clock is still ticking. The Strait of Hormuz, through which roughly 1/5 of the world's daily oil supply passes, sits at the center of this geopolitical firestorm. G7 finance ministers have convened emergency meetings to discuss contingency plans. European energy strategists are privately warning clients to prepare for oil shortages within weeks should the strait be disrupted. Oil settled at $102.46 today, down nearly 3% from recent highs. Do not mistake this single-day decline for relief. Crude oil consistently above $100 per barrel is a tax on consumers and a significant drag on the global economy. The EU is already downgrading growth forecasts while simultaneously raising inflation expectations. This is the textbook definition of stagflation. Gold held above $4,578, signaling sustained safe haven demand from institutional investors. The dollar slipped modestly on the day, adding another layer of cross-border uncertainty. This is precisely the environment where the global value investing pioneer John Templeton would urge investors to look past the immediate fear. Templeton famously built his fortune buying stocks at the point of maximum pessimism throughout his career. And while the headlines are genuinely frightening, that is precisely when disciplined, long-term investors start making their shopping lists. Nvidia and the AI rotation. Perhaps the most fascinating dynamic of today's session was the sharp divergence happening within the technology sector. Nvidia fell 1.3% ahead of its earnings report, which is expected later this week. Options markets are flashing unusually high implied volatility around the report, suggesting traders expect a significant move in either direction. But while the semiconductor leader slipped, enterprise software names rallied impressively. Salesforce surged 3.4%, making it one of the best performers in the S&P 500 today. Cisco Systems gained modestly after delivering a strong earnings beat and hosting its first-ever AI defense event. This rotation tells a compelling story about where we are in the artificial intelligence investment cycle. The first phase of the AI trade was all about infrastructure, building data centers, buying graphics processing units, laying fiber optic cable, and installing networking equipment. That phase is maturing. Phase 2 is about monetization. Companies that can sell AI-powered software and services to businesses are now beginning to take the lead in market performance. Cisco's strong quarterly results confirm that enterprise networking spending is accelerating. Businesses are upgrading their networks to handle AI workloads. Salesforce is demonstrating that generative AI can drive measurable revenue growth in customer relationship management software. The rotation from hardware to software is real, and it creates specific opportunities for investors who pay attention. Stock picks for the week ahead. Let us now examine where these powerful crosscurrents create opportunity across 4 different investing styles. For conservative investors seeking a defensive anchor with reliable income, the father of value investing, Benjamin Graham, would point to Cisco Systems (CSCO) at $118.88. Graham's core principle was margin of safety, buying a dollar's worth of assets for substantially less than their intrinsic value. Cisco trades at just 16 times forward earnings, yields 2.5%, and sits directly in the path of AI infrastructure spending. This is exactly the kind of high-quality, reasonably priced stock that Graham built his legendary investing approach around. For balanced growth, consider Salesforce (CRM) at $179.48. The legendary Fidelity fund manager Peter Lynch always said to invest in what you know and understand. Salesforce powers customer relationship management for tens of thousands of businesses worldwide. Its revenue is recurring, its margins are expanding, and its pivot to AI-powered tools is showing real commercial traction. Lynch would classify this as a steady grower with meaningful runway ahead. For aggressive growth, Rocket Lab, RKLB, at $131.16 deserves a serious look. The pioneer of growth stock investing, Phil Fisher, emphasized finding companies with superior research and development before the broader market fully appreciates their potential. With SpaceX accelerating its IPO timeline, the entire space sector is being revalued by the market. Rocket Lab jumped more than 5% today on that exact catalyst. Fisher would say to identify great growth stories early and hold them through the inevitable volatility. And for value-conscious investors who want income with upside potential, Ford Motor Company, F, at $13.03. The disruptive innovation investor Kathy Wood focuses on the S-curve of transformation in her investment approach. Ford is pivoting from a traditional automaker into an energy transition and mobility company. Its 5.8% dividend yield provides a substantial income cushion while that transformation plays out over the coming years. Wood would recognize the innovation cycle at work here. So here's where we stand as we head into what may be the most consequential trading week in months. Markets closed mixed today, but the real story is the underlying rotation taking place beneath the surface. Warsh is coming to the Fed and the entire rate paradigm is shifting. Iran remains a geopolitical ticking time bomb with oil at the center. And Nvidia will report earnings within the next 48 hours, setting the tone for the entire AI sector for the rest of the quarter. Any one of these events could define the week on its own. Together, they demand an exceptional degree of caution and discipline from every investor. Cash is a position. It is not a sign of indecision but rather one of preparedness and strategic patience. We are holding 72% in cash with tight stops locked in on every equity position. This is a week for patience, for discipline, and for careful preparation. When the uncertainty eventually clears, as it always does, the investors who kept their powder dry will be the ones who can act decisively when opportunity presents itself. Keep your eyes on the yield curve, watch the oil charts closely, and listen carefully to what Nvidia tells us about AI demand. Those 3 things will tell you everything you need to know about where this market is headed in the coming weeks. I'm Chloe. Don't forget to like and subscribe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.